Welcome, everyone, to FNA's second Treasury Broadcast. Apologies for being a few minutes late. I guess you would refer to them as technical difficulties. In reality, we were having some problems with Zoom audio, but here we are, everything's good, we're all on. So our broadcasts FNA sit across a number of topics, including CBDCs, soup tech, but this area of focus, namely Treasury liquidity, is one that's particularly interesting for FNA, so it's great to have it up and running now, second episode and well into its stride. So thank you everyone for joining. Last session, we had two cracking guests from Deutsche Bank and Lloyds. This session, we continue that caliber with two guests from Goldman Sachs and Standard Chartered Bank. Before we introduce them and get started with the session, I'll just cover some very quick housekeeping. So this session follows a 60-minute format. Roughly 45 minutes of that is speaking with our guests. And then we typically have a 15-20-minute Q&A at the end. If you'd like to ask a question, please do so. I would just ask that you don't use the chat functionality. It gets quite noisy in there and questions tend to get lost. So if you have a question, ask it using the Q&A widget at the bottom of your screen, and then our guests will cover as many of them as we can at the end of the discussion. So next slide, please. So I'll just explain very quickly what FNA does. FNA is an advanced analytics and simulation technology company. We work across four core sectors, namely central banks, commercial banks, payment systems, and national security. So our software is solution-based per sector. So where a central bank might use our technology for RTGS stress testing purposes, a commercial bank will use the same underlying tech to optimize their liquidity in real time. Which brings me very nicely onto the next slide, which covers our intelligent liquidity optimization solution, something we refer to here at FNA as ILO. So this was built off the back of running analytics and simulations on critical payment systems, infrastructures, networks. ILO actually optimizes liquidity in real time for banks. So we do this by resequencing payments in an optimal manner using our own algorithms and technology. So this results in significantly less payment delays, low liquidity buffers, and more importantly, low liquidity costs for banks. So we're implementing ILO with a number of GSIBs at the moment. The plan is to present some of their journeys using ILO in some of the future episodes. So stay in touch for those. So on to our discussion. I'm going to hand you over to Philip Straley, who is president here at FNA, who works very closely with our banking partners. Philip will introduce our speakers and then we'll move on with the discussion. So Philip, thank you, over to you.
Okay, thanks very much, Anthony. Thanks for the introduction and welcome everybody. And thank you for joining the second in our series of Treasury broadcasts with two very experienced technology and tech leaders, Neil Thomas and Alan James Anderson. Technology has been a key differentiator in the banking sector really since there was a banking sector. We go back into the mists of time and look at, for instance, in the mid-19th century, the use of the telegraph machine, which I believe was first used by Rothschilds in the 1840s to keep abreast of stock and currency prices. More recently, in the realm of some of our lifetimes on this broadcast, the ATM was introduced amazingly. Some of us actually remember this. It was actually first introduced in the late 60s by Barclays. And now, obviously, tech adoption has moved toward modern database technology, cloud computing, advanced analytics, and AI. And we are lucky to have two guests today representing Goldman Sachs and Standard Chartered, both of which are banks that have, for many, many decades, placed a premium on tech investment. Specifically, we're going to be addressing technology challenges in bank treasury today, stretching across liquidity and funding management, and the related areas of data management, liquidity reporting, collateral, and transfer pricing. During this session, our focus will be on tackling the technology challenges encountered in each of these areas, And we should also know that this has been one of the more dynamic areas of tech application really over the last 12 to 15 years since the global financial crisis. This has been driven substantially by stepped up regulatory expectations. So for instance, BCBS 248, new capital regimes as well, rapid rate increases, particularly over the last 18 months, changing payments dynamics as we move towards shorter settlement cycles, changing customer expectations in line with that, as well as the fact that we have new technologies that are enabling us to do things that we simply couldn't do 12 or 15 years ago in production. So in this session, we're looking to bring out effective strategies for addressing these challenges. And Neil and Alan will also provide their own takes on how recent market events have impacted prioritization of these in their own institutions. So Neil and Alan, again, thanks very much for joining us today. And why don't we go ahead and dive right in? So I guess to level set, it would be useful to hear from each of you on your role or roles, your current responsibilities, as well as how this fits into the overall approach and structure for treasury and liquidity management in your organization, as well as treasury and liquidity tech and engineering. So perhaps Neil, first to you.
Thank you very much, Philip, for the introduction, and I guess it's great to be here as part of this conversation. Hello, everybody. My name's Neil Thomas. I work as the Global Engineering Lead for Real-Time Liquidity Management inside the Corporate Treasury Division. I've been in this role for over 3 years. I guess the way I describe the organization is, we organize ourselves in the division into multiple pillars, and I'm in the liquidity pillar overseeing the real-time applications. I guess quite a lot of the, ethos and the mindset around the way we organize the pillar and the engineering team is really one of front to back. And really what that's trying to do is, align accountabilities and make sure the engineering teams and the quantitative developers sit alongside the business and get an awful lot of co-location and proximity benefits to effectively evolve and innovate alongside. So over the 3 years I've been in this role, we've been very much thinking about our investment strategies in terms of uplifting our tool sets to manage liquidity in the moment, as markets are open, make the systems be real-time aware of the ongoing demands of Goldman Sachs across all the jurisdictions we operate around the globe, make sure we honor those obligations and effectively make the right decisions in terms of managing the liquidity in an efficient manner and make sure we meet the regulatory requirements. We operate globally. As you might imagine, we have to kind of align to all clients around the globe, and the engineering team is one team. We carry the baton around the globe to make sure we manage early currencies, European currencies, US currencies, and effectively close shop with making sure we meet all of our obligations on a daily basis. So a lot of monitoring, escalation, and making sure we hit our OKRs each day that we operate.
Excellent. That's a great lead off. Thank you, Neil. Over to you, Alan.
Thanks, Philip, and hello, everyone. My name's Alan Anderson. So I run Liquidity Technology within Standard Chartered. That's part of the functions technology group within Standard Chartered. So maybe starting a little bit with how Treasury is organized. So within under the group treasurer, within the Treasury department, you've got liquidity, capital, Treasury markets, and within liquidity, you've got FTP, IRBB as well. So funds transfer pricing and interest rate risk as well. And then we have Treasury Services Division, who supports nostril management, which is the intraday liquidity function. And then cross-cutting across all of those things, we have a sort of global finance operations division, who are essentially the operators of the platforms that I support. So I'm responsible for all the technology platforms that support all of those Treasury functions. Probably a little bit different to Neil in that my focus is probably skewed more towards risk management and risk reporting, and then business analytics off the back of those risk measures, whether they are liquidity measures, interest rate risk measures, or indeed the pricing measures when it comes to FTP. Again, I guess similarities in that what we attempt to do is, report specifically the liquidity measures on a daily basis, as close to start of day as possible, for the regional treasurers, regional finance groups, and regional businesses, and then some of the other measures like interest rate risk is a sort of lower cadence. It's weekly or monthly. We report those measures. Intraday liquidity is part of my domain as well, although it's probably a smaller part than Neil. But yeah, I mean, similar as far as looking to provide a real-time view of our nostros and an ability to forecast them in as close to real time as possible. A global team, again, we have presence across sort of east and west, and then, as I say, supporting the regional finance and regional treasurers in in each of those domains.
Excellent, thank you. Excellent. And I think that underscored the fact that and I think we're very we feel lucky to have I guess two institutions that not only have prioritized tech investment for a long time, but I think also represent very different business models and operating models. With GS very wholesale focused, only became a bank holding company in 2008 or 2009. Very focused in the major markets, big securities and trading house, and Standard Chartered very much emerging market focused, very large US dollar clearing operation. It's probably fair to say, at least historically, somewhat less centralized than GS, and that many of the large global commercial banks like Standard Chartered, I'd say it's been a bit of a pendulum swing in terms of centralization versus decentralization of different functions. So I think that was a very good leadoff perspective, guys. So thank you very much. Keeping it high level, based on your experience, what are some of the key liquidity technology related obstacles that banks face, or that your own bank has faced, when implementing real-time solutions for cash, for securities, for collateral? And I think as a corollary to that, it would also be useful to get your perspectives on kind of how you see your own organization, within the broader group of GSIB banks. We assume that you talk and liaise with many of your peers and other institutions. So it'd be great to hear both about some of the challenges and obstacles in real time, and then I guess how you view the rest of the market as well. So maybe start with you, Alan. That's all right?
Yeah, okay. Yeah, sure. So I think when it comes to real-time liquidity management, so what I call intraday liquidity within SCB, I think the first thing that comes to mind is sort of information and cybersecurity. So within functions, obviously we're consuming trading and settlement events, both internally and from our custodial banks, in order to match those. That includes some sensitive information, personal information, customer information, and certainly in our change programs, that's provoked quite a lot of attention from a compliance point of view, and required us to implement some relatively special measures within the sort of functions domain to sort of handle that information security element. And that's only, I guess the bar has only been risen in that domain, sort of in my career, in the years that I've been working in this domain, and continues to do so. We have regulators that are expecting us to demonstrate our cyber resilience and information security controls and so on. So I think that's one of the first things that sort of came to mind. I think the other challenge that we have internally, I mean, you sort of touched on it, is that, you know, Standard Chartered's gone through periods of centralization versus decentralization. The fact is that we have a number of regional specifics, you know, whether that's the you know, payment and settlement networks that we connect to, or indeed whether it's the you know, the trading platforms that we've set up in particular regions that then, you know, are sending us the ledgers that we need to match on a real-time basis. So that's complex, right? For an organization of the size of Standard Chartered, it's complex because of its regional diversity. And really that translates into, I would say, a sort of increasing cost, right? So the cost of ownership of our systems, especially when we're trying to centralize them, when we're trying to have a sort of global platform with regional specifics, it's a sort of art as well as a science to you know, to arrive at a point that's you know, sort of cost effective as far as running the systems. And that can be anything. As I say, we need to make sure the systems are configurable rather than sort of hard coded, you know, to make them as flexible as possible. Or indeed, it can be sort of the ongoing cost of change. So, you know, we are in the intraday liquidity space, we are exposed to sort of every business strategy, you know, as far as, you know, what they're looking to do on their trading systems and you know, the strategies as far as replatforming upstream. And that then means that, you know, we don't always control the delivery roadmap because, you know, we have to react and we have to support the, you know, the business strategies and the you know, the replatforming that happens in the trading domains. And that's why, you know, we have to sort of stay as agile as possible within the systems landscape. Just a couple of other things. So, you know, the data quality is generally a sort of big driver of success, and that applies both to real time, but also the sort of risk reporting that we do on a daily end of day basis. So again, along the lines of sort of the dependencies that we have with the rest of the bank, it's not just sort of their strategies in the trading domains, but it's also their ability to provide us accurate, timely, you know, comprehensive data in order to run these liquidity management functions. So those are some of the things that came to mind. I can't comment too much on where we sit on the intraday liquidity space versus our competitors. I have to admit, I don't have an awful lot of market intelligence on that. I think as far as liquidity risk reporting is concerned, we feel relatively good about ourselves in that we run a lot of our risk measures, you know, daily. When you know, speaking to peers, they tend to, you know, either approximate or don't run at the same cadence as we do. So so I think on the liquidity risk reporting side of things, I think we feel pretty good about ourselves versus the market. But yeah, on the IDL side, it's a bit difficult for me to comment on that.
Yeah. Thanks. Fair enough. Neil.
Yeah, thank you. So I guess, you know, I guess at high level, you know, I kind of describe it as some of the kind of impedance mismatch between trade lifecycle management and liquidity lifecycle management. And really, as firms like ours have grown over the years, they become a lot more complex, a lot more fragmented. And really, you know, in my mind, liquidity management is acting like a funnel through the overall firm, trying to make the best decisions for the whole of the firm, given, you know, a highly complex operating environment across multiple jurisdictions. And to do that effectively intraday, you really need, you know, good integration with trade booking systems, middle office systems, to get ahead of some of the curves in the settlement life cycle. And that's really a challenge when a lot of the systems in banks are quite legacy, you know, so you kind of have to work with what's in front of you, and effectively look for, I guess, patterns that you can implement to address some of those nuances that we have to deal with. So that's one thing I would say. Secondly, a lot of kind of classic treasury functions operate off what I would call traditional balance sheet flows that are quite low cadence, overnight, batch based. And really, when you think about a real-time world, that's very different to kind of seeing data flowing through in the moment to make good decisions. And that I think is hard, and we're still working through that. How do we make the right intraday decisions with real-time flows that are impacting our liquidity profiles, and then make sure our overnight flows that feed into some of our liquidity metric calculations are kept in sync. So that's another one that I would call out as well. Similar to Alan, obviously permissions, entitlements are important to us. I kind of are quite disciplined around not getting access to some of that personal information, because a lot of what we do is based on our overall positional flows that we can work out strategies without necessarily getting access to some of that personal information, but we have to obviously honor those permissions too. And I guess the other thing that we have to deal with is just the uncertainty overrides manual workflows that are in place to deal with connectivity issues, error upstream, and how that feeds into us. And really, that is an ongoing problem in terms of how do we get aware of some of those overrides and manage them effectively. We spend a lot of time, we call it ILR inside our firm. We spend a lot of time thinking about ILR, and we spent the last 2 years implementing, what I would call a standardized ILR approach. And a lot of the investment we've made on, I guess, a standardized strategic front to back model is out there now, and our ILR measurement is off the back of that. And I think we've always traditionally been a very risk averse firm, and a lot of the ILR assumptions and stresses we apply are extremely conservative, and we generally like to get our obligations out ASAP. So the idea that we sit on liquidity is kind of against the DNA of the firm, to be honest. We like to get things out very fast, just to make sure we honor our obligations. So similar to, I don't know how that compares to others on the street, but certainly snippets of intelligence suggest that Goldman is one of the I guess early liquidity providers in many markets. So that's the only bit of it. It's not official, but it's certainly it was all I'm led to believe. I think that's it for me, Philip. I think.
Okay, well that was quite a lot, actually from both of you guys. I mean, maybe just to very quickly summarize what was a whole lot of issues actually that were raised, and you guys raised some of the same, which I would have expected, but also some different ones. Both of you obviously raised the information security angles, and I can attest to that. That's obviously at a premium for all banks. We sit on, at the moment, I'm sitting on the other side of the table of kind of dealing with InfoSec and tech security environments of banks as a vendor, and it can be challenging, to put it that way. I was actually saying to another banker earlier this morning that we also work heavily with central banks, and they're much easier to deal with, even though they have a bigger and arguably more sensitive data set as they gather more granular data than an individual bank does. But we never have the type of teething problems of going through the security vetting that we do, with any of the large banks free. So that's clearly an issue. I think you both also touched upon the very important issue that, obviously liquidity management is serving the entire bank or the entire firm, which means that you're very dependent on upstream systems that often have not been architected historically to deal with the types of data and the types of flows that real-time liquidity management functions require. So those are a couple of the key issues, and I don't want to kind of go down into too much detail on those and restate what you said. So I think that was very well spoken on both of your parts. I guess a follow-up question to that is obviously, I mean, Alan, you mentioned the fact that a lot of your focus is on the risk aspects of liquidity. Obviously, the spring of this year, Northern Hemisphere spring of this year, broad SVB and Signature and Credit Suisse, et cetera. To what extent have the circumstances of March, April, May impacted, if at all, your own bank's thinking on tech priorities as it pertains to liquidity? Maybe Neil, I'll start with you.
Yeah. So even before that, I guess I was in this seat through COVID and went through retail, SVB early on. And I think the story for us is, we already had a multi-year investment program in place that actually paid off in many ways through these crises. And I guess the investment was really around us defining a global strategy for intraday liquidity management, and one really of convergence, and that's across all asset types, all locations. And what we realized quite early on through that investment was, if we do a good job bringing things together, not just for making good intraday decisions on where to move assets, but actually use that to do real-time explain. And clearly through the SVB crisis, it really was one of knowing where your liquidity is, and do you understand what's happening? Are there any long-term drivers happening? Do we need to worry about? Do we need to take some actions? Do we feel comfortable that this is, not related to the crisis and some other activity? So I would say, as an organization, we were clearly highly focused on monitoring, as any bank would be through that situation. Liquidity is top of the house priority, and then certainly some of the conversations I've always left thinking this is number one priority for the firm. Yeah. So, but that was the case before SVB as well. So I guess I would say the conversations around technical priorities have not really changed. People are extremely thankful that we have had this multi-year investment in place. But obviously, there is a lot we can do going forward in terms of improving our tool sets to be more effective. So yeah, I guess I kind of was in the middle of the journey when this all happened. So I'm just grateful that we did have that in place. Yeah. So hopefully give some insight. Yeah.
Nice. Alan.
Yeah, I mean, so a lot of what Neil said resonates, to be honest. When I look at the platforms that we were dependent on in the spring, largely we've implemented all of those in the last couple of years, right? We weren't relying on 10, 15, 20-year-old platforms to run risk or to manage liquidity intraday. And that in hindsight has sort of paid off and allowed us to do what we needed to do through the period of market stress. Our regulators asked more of us. So on the risk reporting side of things, we were asked to submit more frequently than would be BAU. And again, that meant that we basically got the return on that investment on the platforms, and essentially we doubled down on resiliency. Again, as a somewhat of a reaction to that. But then probably the most insightful thing was our forecasting capability really proved to be very valuable, right? So our ability to sort of very quickly configure new stress scenarios and run forecasted risk based on those, just to check and see, dependent on what might happen in the market, just to check and see where that might constrain the business and across the different treasury risk metrics. So yeah, so I think, and again, that wasn't done necessarily with these stress market situations or this particular stress market situation in mind, but it definitely paid off, our ability to sort of be quite agile with our future our forecast stress scenarios. So yeah, so I think those were the things that sort of came out of that period. Yeah.
Excellent. And I know that in both of your cases of GS and SCB, you have had substantial real-time, particularly intraday programs in place for a while. As many of as you guys and many of the participants on the call would know, our pedigree really is working historically in the market infrastructure space, and we started engaging commercial and investment banks really about 3.5 years ago. And I would say that it's been, if we look across, say the 20 largest GSIBs, leaving aside mainland China, we've seen very, very different levels of focus on the real-time journey in these banks. So we've seen examples of banks that were very early investors, even going back 7 to 8 to 10 years. We've seen other banks that 3 years ago were almost nowhere that have made big strides over the last 3 or 4 years, very substantial strides. And then we've seen some that probably still aren't very, very far down the path. So I think it's great that both GS and SCB have made this a real priority. If we could turn back to the question or the point that both of you guys raised around integration, particularly with upstream systems, but also to it's equally applicable to downstream systems in terms of reporting in your various jurisdictions. What have been some of the key elements that have allowed you, perhaps not seamless integration, but at least effective integration and interoperability between your existing legacy systems and your real-time global platforms that you've been architecting and rolling out? Perhaps Neil, you could start.
Yeah, I guess this definitely keeps me busy, this problem. So I guess, the good news, it's good news or bad news, depending on how you look at it, is that I oversee both the legacy liquidity management systems and the strategic ones. So you can kind of look on that as an opportunity to kind of reverse engineer, unpick the complexity of the legacy. Oh, there's an echo. You hearing an echo? Is it better now?
No, now it seems better.
Okay, good. So I would say, that's I guess one piece of good news. When you look at the two kind of dimensions, upstream and downstream, one of the things that we've been very focused on is, I guess, the separation of real-time use cases, kind of your classic OLTP, high cadence, data pipelines, event streaming and the like, and surfacing that work through that kind of pattern, and then really looking at leveraging more OLAP style use cases, data lake technologies, and really make sure, we're separating those different use cases in a way that, for those things that we may be just using for kind of overnight file and forget use cases, those go into a kind of centralized data lake infrastructure and then offered through very well-defined data contracts. The reverse is true as well, in terms of, looking at legacy data flows that need to be brought into the strategic flows around avoiding, I guess, specializations, point to point, thinking about your abstraction layers. And, we've been, Nima Rafael is our kind of chief data officer in the US. We've got an awful lot of very capable tool sets to kind of reverse engineer data flows, data lineages, and really start to walk the breadcrumbs to understand what are, legacy data sources, what do we deem to be the strategic ones. And I think that's been very, very, very important for us to understand where those crunch points are in the flows. It's not easy, for sure, because, as big banks, as they grow over the years, you end up accumulating all sorts of oddities. But I think, separating the two flows, understanding your data contracts, whether they're old, whether they're new, abstracting away from them. And then when you come to downstream, whether those downstream consumers need to listen into the real-time event streams, or whether they're good to listen onto more lower cadence. We've even introduced micro batches that, may not be listening in the stream, but maybe every 15 minutes, every 30 minutes, every hour, and then obviously your classic end of day. So really that's kind of, making sure we can compartmentalize the right flows to make sure we can deal with some of the things that you've talked about in the question in terms of, being flexible, agile, and giving people, I guess, opportunities to fix their internal data problems whilst we move on with our kind of platform development.
Excellent. Thanks. Alan.
Yeah, again, maybe similar. I think maybe the one area that I would maybe elaborate on that we've found has sort of borne fruit is when we talk about those data contracts between the the upstream providers and our liquidity systems, we apply a phrase called shift left. So what we try and do is we try and include in those data contracts as many of the downstream requirements as possible, right? So try and solve for all the different elements of data quality in the upstream system, so that we're not actually having to deal with them in the liquidity management system or reporting system. And that's been again similar to Neil. That's supported by our CDO policies and guidelines. So it's not something that we have sort of a philosophical challenge with some of our counterparts across the bank. These are global group-wide standards. So really leveraging them, and as I say, putting the responsibility for data quality, in the hands of the data provider rather than making it the problem of the data consumer. So I think that's probably one thing I would elaborate on. But other than that, yeah, similar as far as building the right level of abstraction layers, and then making sure that we're reporting off of appropriate data representations and doing the real time management off of more high performance solutions. Yeah.
Okay. Excellent. Maybe to dig down into, I sound like I am echoing now. Hopefully it's gonna stop. So if we dig down into, I guess, a bit more of a detailed point. Now, obviously, every large bank in the world has a bit of a different stance in terms of build versus buy, in terms of systems as a whole, not just treasury or liquidity. But without kind of naming names, specifics, vendors, etc. How do you guys frame the problem of build versus buy versus kind of partner, co-develop, etc.? Obviously, there are multiple models in that. Maybe Alan, you could take that one first. I think you may be muted, Alan. Okay. We seem to have lost your mic, Alan, which is strange. Maybe you could take that one first, then Neil, and then hopefully we can get the sound back.
Yeah, no, it's fine. So yeah, I guess our firm has a reputation to build versus buy, but that's certainly changed over recent years. So I think a lot of what goes into these decisions is really, I guess, ROI, intellectual specialization, and really liking to control our own destiny, and that's kind of been that way for some time, but I guess there's clearly areas where there really is no secret sauce to some things that we're building. So why build it when you can buy it? Classic examples are kind of payment rail integration, reg reporting, utilities that act as intermediaries that make the whole liquidity system more efficient. Those are kind of no-brainers, really. That there's just no point building and going against the norms of I guess our reporting requirements, etc. I guess when I think closer to home and looking at my systems, my overall mindset is really one of plug and play, allowing people to kind of embed themselves in the platform, whether it be a calculation infrastructure, a ledger, an optimization module, and optimization modules. I think for us to be successful, we need the flexibility to kind of pivot, as circumstances change. And I think one of the problems that I guess I've seen is, becoming dependent on vendors that give you no room for maneuverability when you need to, be flexible. So, and obviously at the end of the day, cost is a big factor in terms of what's the long-term cost. But obviously with cloud becoming, the norm now, a lot of the kind of maintenance and support overheads, it's just becoming a lot easier to get through, tech risk notwithstanding, Philip. But yeah, I think there are less barriers now to kind of, than there were, even 5 years ago. Yeah. So I think it's equalizing in my firm, I would say. Yeah.
Yeah, I think that last is a great point in particular, Neil, around, the facts. This is kind of some of what I was driving at the beginning of the fact that, some of the new technologies simply are just architected in much more open manners that including for real-time event streaming, et cetera, that allow for things that didn't allow for 12 or 15 years ago, effectively.
Yeah.
That's great. Did we get you back, I hope, Alan? Maybe you can dial off and dial back on. That's the old just hit the computer or machine and maybe it will fix itself. Turn it on and off. And maybe while we're doing that, why don't I kind of go to the next question, Neil, in terms of, and perhaps the last question that I'll ask before we'll go to audience questions, so ask you to look a little bit forward. And I guess two embedded questions. One is, what classes of new technology do you see out there now that hold promise for enhancing the overall efficiency of your treasury and liquidity optimization, not optimization, operations? And then second, the corollary to that is, what do you not see in the market now that you'd like to see in the market that would make your job easier?
Yeah, so obviously there's a lot out there that's becoming well known, and I kind of see us on a journey where, a lot of what I've done to date has really been around getting our data platform in a place that's, understood, standardized, and be foundational to some of the predictive tooling out there. So obviously, machine learning and artificial intelligence is out there. Everybody knows that. We've done a number of rollouts, and they do look promising in terms of, when I talked about trade lifecycle and liquidity lifecycle, our ability to take confidence on a pre-settlement activity in an intraday decision point is looking really promising. We're heavily involved in some of the vendor blockchain, and I think when you look at systemic liquidity, we often look at internal flows within our firm and just amazed on the sheer notional that's moving around in the system, and being in a situation where we're not physically mobilizing settlements is going to be hugely beneficial to firms and to the overall state of liquidity systems. Obviously, Chat GPT is out there. Our CAO is all over it. He's in the public space talking about that. We're internally looking at governance in terms of what policies we want to deploy. There's little pockets of POCs. When I think of how we might use that internally, I think a lot of what we do is really understanding the data, providing the context, providing the narrative. I think plenty of opportunity for us to deploy that, in terms of making sure people can intersect and understand the data in a far more timely manner. So those are, I guess, the obvious ones. But I guess I'm a little skeptical of moving too fast in these things because, I always say to engineers that will work with me, as much as we can do right, we can do wrong. Yeah, and I think all of us need to be conscious of that. If you get, an algorithm that's running or a prediction tool that's running away, you need to make sure we detect it and stop it, and before we make any systemic issue out there, which clearly all of us don't want. Your second question, I don't know. I think, I think along the lines of kind of digital assets in terms of, the problems with SVB were really around, a kind of classic run on the bank that wasn't classic, using, like liquidity moved very quickly. Yeah. And I think, the four walls protection of banks, I think, I'm hoping that there's something out there to help us deal with that in the moment better than we've got now, to be honest, because I think, looking at the banks stepping in the US, I think was great to see, but I think we hopefully there's something better out there to I guess get more transparency. I guess the state of liquidity. Yeah, but yeah, nothing better than that, unfortunately, Philip. So.
Okay, no, that's very useful. Alan, do we have you back now? We appear not to. Alan. We'll wait just 30 seconds and see if we can get you back in. Otherwise, we'll probably go to audience questions, and unfortunately, we'll head to audience questions without you, Alan. Unless you want to make answers in the chat, which is also fine. So you can drop a few bullets, and then I could read them out. So we do have a few questions from the audience already. I see 4 or 5 already. Please, if you do have questions, please go ahead and put them in the chat now, and I'll parse these and ask them over the next several minutes. I do see, Neil and Alan, that there is one question, unsurprisingly, from an anonymous attendee that says, in what capacity do you think AI can support your functions better? I think, Neil, you already took a stab at that one. Another one maybe interesting was around API integrations, and to what extent, or it says, what are the potential challenges around API integrations, as well as opportunities for banks in terms of treasury technology connectivity with external systems and third-party providers? You want to try to take that one, Neil? You have any views?
Yeah. So I think, obviously, the business of treasury management and liquidity management is implicitly us integrating with the payment rails of the world. So, in essence, for us to do our job, we're already, going through the SWIFT infrastructure and so on and so forth. So, that's kind of there. I think if you think about, I guess, other intermediaries, then really, I guess the key challenge is not really a lot different to the internal challenge I talked about earlier on, in terms of you tend to find, vendors and utilities defining, API contracts that, are internally designed by them, and they don't match perfectly with the internal structures of the firm. So that's no different from me taking data from somewhere else inside in the four walls of Goldman Sachs. But that's what I find is one of the key things. So you find there's an awful lot of mapping technology that's available to join those two things together. And then really where we worry about then is really resiliency, in terms of, if we lost connectivity to the API, how critical is that data to the functioning of the treasury systems? And we've obviously had cloud outages as well, where people wouldn't have dreamed of that a cloud provider would not become available. So the risk is always with the bank, and really we need to really understand those I guess bad day scenarios, externally, and we generally get more comfortable internally. I guess back to the question on buy versus build, but in essence, if you can answer those questions properly, then it's much the same, to be honest.
Yeah. Actually, maybe just a follow-up question to that, Neil. And I don't remember you and I talking about this previously. GS, I think, is at an interesting point in its life cycle, as I understand it now, in terms of integrating to high-value payment systems directly. So, I mean, historically, you've obviously been a direct participant in many of the high-value payment systems in the world, but in others, I know you've recently joined CHAPS over the last couple of years. You've recently joined CHIPS over the last couple of years as a direct participant. How much focus has that been for your team in terms of integration and also the business flows and how could those get enabled?
Yeah, so fortunately, I'm somewhat decoupled. Back to the abstraction of the API. So we defined, I guess a payment integration. I say points because there's not one, there's several of them, and really a lot of the flows that we've worked on over the years is really a consequence of us becoming a bank and wanting direct access to those rails, because it's important for us to get I guess direct access for our clients, and really for us to perform liquidity management, it's really around intersecting the obligations and inflows and outflows of payments through those new rails into our internal systems. And I think, I guess, people are familiar with transaction banking. Transaction banking is one of our growth areas. So they are looking to quite a lot of interesting strategies around, I guess, efficiency for liquidity for some of our clients. So that's really with them. I don't really have direct insight on that, but from my perspective, we just treat it like another channel coming in, and somewhat decoupled. Yeah. Right.
Okay. And then maybe just one closing question, Neil, and unfortunately it'll be just to Neil, given that we appear to have completely lost Alan now. Neil, coming back to one of the first comments you made in the session, around you said liquidity management is really for the whole firm. One of the observations we have is that in working with banks in this space is that it's an extraordinarily interesting or challenging, you could use other less polite words, landscape in terms of stakeholder management. How do you find, given that you've got payments operations, you have core liquidity, you have your cash and transaction banking teams, you have effectively all the business units in GS from a transfer pricing perspective. I guess what have been some of the key lessons learned you've had around stakeholder engagement, stakeholder management, and what's worked and what's not worked so well?
Yeah, it's definitely difficult, and I guess it's really around the alignment of incentives, really, in terms of if I'm growing a new business inside Goldman Sachs, then a lot of my measurement of success is the growth of that business, and really, the firm has to accept that there is a price to pay to grow a business. So a lot of it is really down to obvious compromise that you have to make with certain stakeholders. But then there needs to be a constraint to that. That's there's only so much we can compromise on, and then those individual segments need to think about the firm as a whole a bit when the notionals get bigger and all the rest of it. It needs to kind of follow the classic liquidity flows. So I think a lot of it is really around negotiating the right transition phases to support the businesses wherever they are in their journeys, and making sure people understand the overall strategy of the firm and the consequences for the firm. So yeah, but it's not easy. It's certainly not easy. Yeah, to in those conversations. So.
All right. Well, Neil, thank you very much again for being here today. Alan in absentia, I just got an email from him. Apologies for the connectivity issues. Alan, thank you as well. Hopefully you'll see the thank you when you hopefully watch the video when it's posted. I think Anastasia, our colleague, has put contacts, so LinkedIn connections for Neil and Alan, as well as myself here. So feel free as participants to get in touch if you have any further questions with any of us. I guess just a bit of a marketing note, we have 2 other broadcasts coming up. In fact, this week, one tomorrow, an instance of our CBDC broadcasts tomorrow morning UK time, and on Thursday our SupTech broadcasts on at 2 o'clock in the afternoon. Again, great guests. Please tune in, have a look, and thank you very much, everybody, for joining us. We'll be announcing the 3rd Treasury broadcast here over the next couple of weeks, so look out for that. Thank you.